4 times a year, every large investment firm in America is legally required to publish exactly what they own. Warren Buffett, the biggest hedge funds in the world, the people managing hundreds of billions of dollars, all of them forced by law to show you their positions. It's free and it's public. Anyone can read it in about 10 minutes, and almost nobody does. Think about how strange that is. People will spend hours scrolling for stock tips from anonymous accounts, chasing screenshots and hype, while a document showing what the most sophisticated capital allocators on earth actually did with real money sits online, free, unread. That document is called a 13F. And by the end of this video, you'll know how to read one, what it actually tells you, and just as importantly, the 3 ways it will lie to you if you don't know its limits. Because here's the thing about cheat codes. They only work if you understand what they don't do. I'm Daniel Ayala. I manage a fund professionally, and reading institutional filings is a routine part of that job. Not because they tell me what to buy, but because they tell me what the smart money is positioning for, which is a much more useful thing. Most people who mention 13Fs on the internet misuse them badly and they lose money doing it. So I'm going to give you both halves, the genuine edge and the trap. Let's get into it. Let's start with the mechanics because they're simple and almost nobody knows them. Any institutional investment manager in the United States controlling more than $100 million in certain publicly traded securities has to file a form with the Securities and Exchange Commission. That form is called a 13F. It lists their equity positions, what stocks they hold, how many shares, and the market value. They file it 4 times a year within 45 days after the end of each quarter. So a filing covering positions as of the end of March gets published sometime around mid-May. That 45 delay matters enormously, and we'll come back to it. It's the first trap. The filings are all published on the SEC's own website in a free database called Edgar. You type in the name of a firm, you find their 13F, you read exactly what they own. That's it. There's no paywall, no subscription, no special access. The most powerful investors in the world are legally compelled to show you their homework, and the barrier to reading it is roughly a Google search and 10 minutes of attention. Now, the interesting part, what can you actually learn from this? The naive answer is which stocks to buy. That's the wrong answer, and I'll explain why shortly. The sophisticated answer is that a 13F tells you 3 things that are genuinely valuable. The first is conviction through size. It's not that a firm owns a stock. It's how much of their portfolio that stock represents. A fund that puts 20% of its assets into one company is telling you something completely different than a fund that put 0.5% into it. The position size is the message. When you look at a 13F, don't read it as a list of names. Read it as a map of conviction. Where did this person who thinks about this for a living decide to concentrate real risk? The second is change over time. A single 13F is a snapshot. 2 consecutive 13Fs are a story. Did they add to a position or trim it? Did they exist? Did they exit something entirely? Did they start something new? The direction of a change tells you what their thinking is doing, and it's far more informative than the static holdings. A firm cutting a position by 70% is saying something loud, even if they still technically own the stock. The third, and this is the one almost nobody uses, is what the portfolio structure reveals about their view of the world. Are they concentrated in a handful of names or spread across dozens? Have they rotated out of an entire sector? Are they holding enormous cash reserves that show up as an absence of positions? When Berkshire's filings show a massive cash pile alongside a shrinking equity book, they aren't telling you buy this stock. They're telling you we can't find enough things worth owning at these prices. That's a statement about the entire market, not about any single name. And that's the real signal hiding in plain sight that most people scroll right past while hunting for tickers. Now, the part that makes this an actual skill rather than a dangerous habit, there are 3 serious limitations, and every person who's ever lost money copying Buffett ignored at least one of them. Limitation 1, the information is stale. Remember that 45-day delay? By the time you read a 13F, the positions it describes are between 45 days and 4.5 months old. The manager may have sold the entire position weeks before you ever saw the filing. You are looking at a photograph of a room that everyone may have already left. Trading off a 13F as if it's current is like navigating using a map of where the ships used to be. Limitation 2, it's a radically incomplete picture. A 13F only shows certain long equity positions. It does not show short positions, bets that a stock will fall. It doesn't show most bonds, commodities, currencies, or foreign listed holdings. It doesn't show cash directly. And critically, it doesn't show hedges. So a fund might appear to have a huge bullish bet on a company while simultaneously holding an offsetting position that doesn't appear anywhere on the form. You are seeing one wall of a house and imagining you understand the architecture. Copying a position you can only half see is how people take on on risk they never intended. Limitation 3, and this is the one that really matters. Their situation is not your situation. A large fund's time horizon, tax position, capital base, and risk tolerance are nothing like yours. They might hold a position that drops 60% for 3 years because it's 2% of their book and they have a decade-long thesis and permanent capital. If you copy that position at 10% of your net worth with a 2-year horizon, the same trade that's rational for them can be ruinous for you. The same position is a different decision depending on who's holding it. That sentence is worth writing down. Position identity is not strategy identity. So how do you use this properly? Here's the shift. Stop reading 13 F's for answers and start reading them for questions. When you see that a great investor built a large position in a company you'd never consider, the correct response is not buy it. The correct response is, what do they see that I don't? That question sends you to research the company yourself. Maybe you find the thesis and it's compelling. Maybe you find it and it doesn't fit your situation at all. Maybe you can't find it, in which case you've learned that you don't understand the trade and you should never own something whose thesis you can't articulate. The 13F is a research prompt, not a shopping list. It's a curated list of ideas that serious people risk real money on, which is a far better starting point than a screen full of tickers or somebody's posts. But it's the start of your work, not a substitute for it. And the deeper use, the one that separates people who get real value from this, is watching aggregate behavior across many filings. One fund buying gold miners is noise. 20 sophisticated funds simultaneously rotating out of a sector or piling into cash or quietly building positions in the same overlooked corner of the market, that's a signal. That's a signal about how professional capital is positioning for a world that hasn't arrived yet. You're not copying trades. You're reading the collective posture of the people who think about this full time. That's the actual cheat code. Not what did Buffett buy, but what are the most patient, best informed allocators in the world collectively preparing for. So here's the whole thing in one frame. 4 times a year, the smartest money in the world publishes its homework, free for anyone to read. Most people ignore it entirely. Of the ones who read it, most misuse it. They copy stale positions they only half see from people whose situation is nothing like theirs, and they wonder why it doesn't work. The people who get the edge do something different. They read for conviction, not names. They read changes, not snapshots. They read a structure of a portfolio to understand a worldview. They treat every interesting position as a question to research, never an instruction to follow. And they watch what many institutions are doing collectively because that's where the real information lives. None of that requires special access, a Bloomberg terminal, or money. It requires a free website, some patience, and the discipline to use a powerful document for what it actually is instead of what you wish it were. That's the cheat code. It's been sitting there, free and public, the entire time. The only reason it's an edge is that almost nobody bothers. If this is the kind of thing you want more of, real tools used correctly without the hype, that's exactly what my free weekly note is. Every week, I take something happening in the markets and break down what the sophisticated money is actually doing and why, in plain language. No predictions, no tips, just thinking. Links in the description. And here's your homework if you want it. Go to the SEC's Edgar database this week, pull one filing from one investor you admire, and don't look for a stock to buy. Look at their biggest position and ask yourself, why would someone smart put that much of their money there? Sit with the question. That single exercise will teach you more about investing than a month of scrolling for tips. If this was useful, pass it to someone who's still hunting for stock picks in the comments section of the internet. There's a better way, and it's free. I'm Daniel Ayala. Thanks for watching. I'll see you in the next one.